What if I told you that one of the most valuable metals on Earth is being systematically held down in price, and the evidence is hiding in plain sight? Not conspiracy theory, not speculation. Court-documented, settlement-proven manipulation that cost major banks nearly $1 billion in fines. And right now, the very mechanisms that kept silver suppressed for decades are starting to crack. Let me show you something that should make your blood boil. Every single trading day, like clockwork, silver gets hammered during New York morning sessions. The price drops. Then, mysteriously, it recovers during European and Asian trading hours. This isn't random. This is a pattern that's been documented by traders, analysts, and now, federal regulators. The question isn't whether silver's been manipulated. The question is, what happens when the manipulation finally breaks? Because here's what most people don't understand. Silver isn't just another precious metal. It's the most electrically conductive element on Earth. It's in your phone, your car, your solar panels, your medical equipment. Every electric vehicle uses up to 1 kilogram of silver. Every solar panel installation requires significant silver content. The green energy revolution, it runs on silver. And we're running out. The Silver Institute just confirmed something extraordinary. We're entering the 5th consecutive year of structural supply deficit. Think about that. 5 straight years where global demand exceeds what we can mine out of the ground. In any normal market, prices would be skyrocketing. But silver? It's been held in check until now. Let me take you back to September 2020. J.P. Morgan Chase, one of the largest banks in the world, agreed to pay $920 million to settle charges of precious metals manipulation. Not alleged manipulation, proven manipulation. The Commodity Futures Trading Commission documented thousands of instances of spoofing, where traders placed fake orders to manipulate prices, then canceled them before execution. This wasn't some rogue trader. This was systematic institutional manipulation spanning nearly a decade. But here's where it gets interesting. That settlement was just the tip of the iceberg. The manipulation tactics they used, the paper market games they played, those mechanisms are still in place. They're just more careful now. The COMEX futures market, where silver prices are supposedly discovered, has been the primary tool for this suppression. And right now, that market is showing signs of severe stress. Let me explain how this works, because once you see it, you can't unsee it. The COMEX is a futures exchange where contracts for silver delivery are traded. But here's the dirty secret. Most of these contracts never result in actual silver changing hands. They're settled in cash. It's paper silver, not physical silver, and for years banks could sell unlimited paper contracts, creating artificial supply that didn't exist in the real world. This kept prices suppressed even as physical demand soared. Think of it like this. Imagine you're selling tickets to a concert venue that holds 1,000 people. But instead of selling 1,000 tickets, you sell 10,000. Knowing that most people will just resell their tickets or accept a refund rather than actually show up. It works fine until everyone decides they actually want to attend the concert. Then you have a problem. That's where we are with silver right now. The physical market is screaming one thing. The paper market is saying something completely different. And the gap between them is widening every single day. Industrial users are paying premiums above spot price to secure physical silver. Mints are struggling to keep up with demand. Delivery delays are extending. Meanwhile, the paper price on COMEX suggests everything is fine. It's not fine. Let me give you some numbers that should terrify anyone betting against silver. Global silver demand hit 1.2 billion ounces recently. Annual mine production? Around 830 million ounces. That's a deficit of roughly 370 million ounces that has to come from somewhere. It comes from above-ground stockpiles, recycling, and investor selling. But those stockpiles are depleting. Recycling can't keep up with demand growth. And investors? They're becoming buyers, not sellers. The industrial demand story alone is staggering. Solar panel installations are projected to consume over 150 million ounces of silver annually within the next few years. Electric vehicle production is ramping up globally. 5G infrastructure requires silver. Medical applications are expanding. Every single one of these sectors is growing, not shrinking, and there's no substitute that matches silver's unique properties at scale. But let's talk about what's really driving this suppression, because understanding the why is crucial to understanding when it breaks. Central banks and major financial institutions have a vested interest in keeping precious metals prices contained. Why? Because rising gold and silver prices signal inflation, currency debasement, and loss of confidence in fiat money. When silver was at $50 in 1980, it was a screaming alarm that something was wrong with the dollar. When it hit $49 in 2011, same story. Both times, massive intervention brought prices back down. Here's what happened in 1980 that most people don't know. The Hunt brothers tried to corner the silver market, accumulating massive physical positions. Silver went from $6 to $50 in a matter of months. The establishment panicked. The COMEX changed the rules mid-game, implementing Silver Rule 7, which essentially banned new buying and only allowed liquidation. The Hunt brothers were forced to sell, prices collapsed, and the message was clear: don't mess with silver. Fast forward to 2011. Silver rallied from $18 to $49 in less than a year. The reasons were different, driven by post-financial crisis monetary expansion and investment demand. But the response was similar. Margin requirements were raised 5 times in 8 days. That's not normal market regulation. That's intervention designed to break momentum and force leveraged players out. It worked. Silver crashed back to $26 within weeks. But here's what's different this time. The structural deficit is real and growing. The industrial demand is non-negotiable. You can't build solar panels without silver. You can't manufacture electric vehicles without silver. The green energy transition that governments worldwide are mandating requires silver. And unlike investment demand, which can be fickle, industrial demand is sticky and growing. Let me paint you a picture of what's happening right now in the physical market. Dealers are reporting unprecedented demand from retail investors. Premiums on physical silver coins and bars are running several dollars above spot price. That spread used to be pennies. When you see premiums expanding like that, it means the paper price and the physical reality are diverging. It means the suppression mechanism is losing its grip. And then there's the COMEX inventory situation. This is where things get really interesting. The amount of silver registered for delivery, meaning it's actually available to fulfill contracts, has been declining. Meanwhile, open interest, the number of contracts outstanding, remains elevated. This creates a potential squeeze scenario. If even a small percentage of contract holders demand physical delivery instead of cash settlement, the exchange could face a crisis. Now, some of you might be thinking about retirement accounts, about protecting wealth for the long term. And that's smart because what we're seeing in the silver market is really a symptom of a larger monetary problem. When you have systematic price suppression in a critical industrial metal, it tells you that the financial system is more fragile than it appears. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement savings, I put together a free guide on how gold IRAs work. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. Worth checking out if you're thinking about diversification and wealth preservation. No pressure, just information. Anyway, back to what's happening with silver right now, because the timeline is compressing. The manipulation tactics that worked for decades are running into an immovable object, physical reality. You can manipulate paper prices. You can't manipulate geology. You can't manipulate industrial demand. And you can't manipulate the laws of supply and demand forever. Let me tell you about backwardation because this is a technical term that signals serious market stress. Normally, futures contracts for later delivery trade at a premium to spot prices. This is called contango, and it reflects storage costs and interest rates. But when the market goes into backwardation, where near-term contracts trade at a premium to longer-dated ones, it signals physical shortage. It means people are willing to pay more for immediate delivery than future delivery. Silver has been flashing backwardation signals intermittently, and each time it happens, it's a warning sign. The banks know this. The regulators know this. The question is whether they can keep the lid on long enough for the structural problems to resolve themselves. Spoiler alert, they can't. Because the deficit isn't going away. If anything, it's accelerating. The Silver Institute projects the supply deficit will persist through the end of the decade. That's not a short-term imbalance. That's a fundamental shift in market dynamics. Now let's talk about what happens when suppression breaks, because history gives us clues. In 1979 and 1980, silver went from $6 to $50. That's more than an 8x move in roughly 18 months. In 2010 and 2011, it went from 18 to 49. That's nearly a 3x move in about a year. Both times the moves were explosive once they started. Both times the establishment intervened to stop them. But both times the underlying monetary problems that drove those rallies didn't go away. They just got papered over. This time, the monetary backdrop is even more extreme. We've had over a decade of unprecedented money printing. Central bank balance sheets have exploded. Government debt levels are at peacetime records. Inflation, the real kind that erodes purchasing power, is embedded in the system. And unlike previous cycles, we now have massive industrial demand on top of investment demand. The perfect storm. Let me give you some perspective on what industrial demand really means. A typical solar panel installation for a home uses roughly 20 grams of silver per panel. Doesn't sound like much, right? But when you're talking about millions of installations globally, it adds up fast. The solar industry alone is projected to consume more silver in the next decade than was mined in the entire 20th century. Think about that. One industry consuming more than a century's worth of production. Electric vehicles are similar. Each EV uses about 1 kilogram of silver in various electrical components. Global EV sales are projected to reach tens of millions of units annually within a few years. That's tens of millions of kilograms of silver, just for one application. And unlike investment demand, which can reverse if prices rise too much, industrial demand is relatively inelastic. Manufacturers need silver. There's no substitute that works as well at scale. The medical industry is another massive consumer. Silver's antimicrobial properties make it essential for wound dressings, medical devices, and hospital equipment. As healthcare expands globally, particularly in developing nations, medical silver demand is growing. Again, this isn't optional demand, this is critical infrastructure. So, you have this situation where industrial demand alone is consuming most of annual mine production. Then you add investment demand on top. Then you add the fact that mine production is relatively inelastic, meaning you can't just turn on new supply quickly. It takes years to develop new mines, and many existing mines are depleting or facing declining ore grades. The supply side is constrained, the demand side is exploding, and the price, it's been held artificially low. This is where the manipulation becomes not just unethical, but economically dangerous. When prices don't reflect true supply and demand, you get misallocation of resources. Miners can't justify developing new projects because prices don't support the economics. Industrial users get lulled into thinking supply is abundant when it's not. Investors miss the signal that something valuable is being underpriced. And when the correction comes, it's violent. Let me tell you what smart money is doing right now because it's instructive. Central banks have been accumulating gold at record pace. They understand that fiat currency is being debased. But silver? Silver is the poor man's gold, the industrial metal with monetary properties. And it's historically undervalued relative to gold. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been running at extreme levels. Historically, that ratio averaged around 15 to 1. Recently, it's been closer to 80 to 1 or higher. That's a massive divergence that suggests silver is either extremely undervalued or gold is overvalued. Given the industrial demand dynamics, it's pretty clear which one. Institutional investors are starting to notice. Silver ETFs have seen significant inflows. Mining stocks are being accumulated. The smart money isn't waiting for the mainstream media to declare silver a buy. They're positioning now, while prices are still suppressed, because once the break happens, once the paper market loses control, the move will be fast and furious. Now, let's talk about the mechanics of how this suppression actually breaks, because it's not going to be a gradual process. It's going to be a cascade. Here's how it likely unfolds. First, you get continued physical tightness. Premiums keep rising. Delivery delays extend. Industrial users start getting nervous about supply security. They begin forward buying, locking in supply at current prices. This removes physical silver from the market. Second, you get a catalyst. Maybe it's a major industrial user announcing they can't secure enough supply. Maybe it's a COMEX delivery default, where the exchange can't fulfill physical delivery requests. Maybe it's a geopolitical event that disrupts supply chains. The specific catalyst doesn't matter as much as the underlying tension that's already built up. Third, you get a rush to physical. Investors who've been holding paper silver, whether through ETFs or futures contracts, start demanding physical delivery. The paper market, which has been operating on the assumption that most contracts will be cash settled, suddenly faces a liquidity crisis. Prices spike as the exchange tries to source physical metal to meet delivery demands. Fourth, you get momentum players and algorithmic trading systems piling in. Once silver breaks through key technical levels, computer-driven trading amplifies the move. Stop losses get triggered. Short sellers scramble to cover. The move becomes self-reinforcing. Fifth, and this is the critical part, you get mainstream attention. Media starts covering the silver story. Retail investors pile in. The fear of missing out kicks in, and suddenly you have a full-blown mania. This is where prices can go parabolic, far beyond what fundamental analysis would suggest. Because markets aren't rational in the short term. They're emotional. The establishment will try to stop it, just like they did in 1980 and 2011. They'll raise margin requirements. They'll change trading rules. They'll jawbone about bubbles and speculation. But here's the difference this time. The structural deficit is real. The industrial demand is non-negotiable. And the monetary backdrop is more extreme than ever. The tools they used before might not work this time. Let me give you a scenario that keeps regulators up at night. Imagine a major industrial user, let's say a solar panel manufacturer, decides they need to secure silver supply for the next 5 years. They go to the COMEX and start taking delivery on futures contracts, not cash settlement, physical delivery. They need the actual metal for production. Now imagine several industrial users do this simultaneously. The exchange would face a crisis. They'd have to source physical silver from somewhere. And if they can't, they'd have to settle in cash at whatever price the market demands. That's a short squeeze scenario that could send prices vertical. This isn't theoretical. This is exactly what happened in other commodity markets when physical tightness met paper market leverage. Nickel on the London Metal Exchange in 2022 is a recent example. Prices went from $25,000 per ton to over $100,000 in a matter of days when a short squeeze developed. The exchange had to halt trading and cancel trades. It was chaos. Silver could see something similar if the physical market breaks away from the paper market. Now, some people will say that governments and central banks will never let silver prices run wild because it would signal loss of control over monetary policy. And they're right to be concerned about that. But here's the thing. They may not have a choice. You can't print silver. You can't create it out of thin air. And if industrial demand requires it and supply is constrained, the price has to rise to balance the market. That's not manipulation. That's economics. The other factor that's different this time is the geopolitical dimension. China has been accumulating strategic metals, including silver, as part of their de-dollarization strategy. Russia has been doing the same. The BRICS nations are exploring alternatives to dollar-based trade, and precious metals, including silver, are part of that equation. If major nations start competing for physical silver supply, it adds another layer of demand that didn't exist in previous cycles. Let me tell you about the mining side of this equation because it's crucial to understanding why supply can't just magically increase. Silver is primarily mined as a byproduct of other metals, particularly copper, lead, and zinc. Only about 30% of silver production comes from primary silver mines. This means silver supply is largely dependent on the economics of other metals. If copper prices are low, copper mines cut production, and silver supply falls as a byproduct. Miners can't just ramp up silver production in response to higher silver prices if the primary metal economics don't support it. Even for primary silver mines, development timelines are long. From discovery to production, it can take a decade or more. Permitting, financing, construction, all of this takes time. And with silver prices having been suppressed for years, there's been underinvestment in new mine development. The pipeline of new supply is thin. This means even if prices rise significantly, Supply response will be slow. And in the meantime, the deficit continues. There's also the grade decline issue. Many existing silver mines are seeing ore grades decline as they mine deeper and extract the easier, higher-grade ore first. This means they have to process more rock to get the same amount of silver. Costs rise. Margins compress. Some mines become uneconomic and close. This is a long-term structural headwind for supply that doesn't get enough attention. Recycling is often cited as a source of supply that can fill the gap. And yes, silver is recycled from industrial applications, jewelry, and old coins, but recycling rates are already high for many applications. There's not a lot of low-hanging fruit left. And as industrial applications increasingly use silver in ways that make recycling difficult or uneconomic, like in solar panels that have a 25-year lifespan, that silver is effectively removed from the supply chain for decades. So you have this perfect storm brewing. Structural supply deficit, growing industrial demand, underinvestment in new mines, declining ore grades, limited recycling upside, and on top of all that, you have a paper market that's been suppressing prices through manipulation tactics that are now under regulatory scrutiny. Something has to give. The question investors should be asking isn't whether silver prices will rise. The question is how high they can go when the suppression breaks. And the answer might surprise you. Some analysts are projecting silver could reach $100 per ounce or higher in the next major move. That's not hype. That's based on supply-demand fundamentals and historical precedent for how silver behaves when it breaks out. Think about what $100 silver means. At current prices around $25 to $30, that's a 3x to 4x return. But it's not just about the percentage gain. It's about what it signals. $100 silver would mean the paper market has completely lost control. It would mean industrial users are scrambling for supply. It would mean investors are fleeing fiat currency and seeking hard assets. It would mean the monetary system is under severe stress. And here's the thing that should really get your attention. Silver has been to $50 twice before, in 1980 and 2011. Both times it got there despite massive intervention to stop it. Both times, the underlying conditions that drove it there didn't fully resolve. They just got papered over with more monetary expansion. Now, we're in a situation where the monetary expansion has been even more extreme, the industrial demand is even stronger, and the supply deficit is even more severe. If silver got to $50 under those previous conditions, where does it go under current conditions? Some of the more bullish analysts are talking about $200 or even $300 silver in an extreme scenario. That sounds crazy until you adjust for inflation and monetary expansion. The $50 silver of 1980, adjusted for real inflation, would be well over $500 in today's dollars. The $50 of 2011 would be over $70 adjusted for official inflation, and much higher if you use real-world inflation measures. So $100 or $200 silver isn't as outlandish as it sounds. It's actually conservative relative to historical peaks adjusted for currency debasement. But let's bring this back to what matters for regular people. Whether you're an investor, a retiree, someone concerned about wealth preservation, or just someone trying to understand what's happening in the economy, the silver story is a microcosm of larger issues. It shows you how markets can be manipulated. It shows you how paper assets can diverge from physical reality. It shows you how monetary policy creates distortions that eventually have to correct. And it shows you that when those corrections come, they can be violent and sudden. The smart play isn't to wait for confirmation that silver is breaking out. By the time it's obvious to everyone, the easy gains are gone. The smart play is to understand the fundamentals, recognize the suppression for what it is, and position accordingly while prices are still being held down. Because once this breaks, once the paper market loses control and physical reality asserts itself, the move will be fast. And most people will be caught off guard. History doesn't repeat, but it rhymes. We've seen this movie before in 1980 and 2011. Both times, silver exploded higher. Both times, the establishment intervened. Both times, the underlying problems persisted. This time, the problems are bigger. The monetary expansion is more extreme. The industrial demand is stronger. The supply deficit is more severe. And the manipulation is documented and proven in court. The silver price is being suppressed. That's not conspiracy theory. That's documented fact. JP Morgan paid $920 million to settle manipulation charges. The COMEX has a history of changing rules to break rallies. The paper market has been used to create artificial supply. All of this is on the record. But suppression can't last forever when it runs into physical reality. And right now, physical reality is screaming that silver is undervalued. The question isn't whether the suppression will break. The question is when. And based on the structural deficit, the industrial demand growth, the depleting inventories, and the stress showing up in the physical market, the answer is sooner than most people think. The mechanisms that kept silver contained for decades are cracking. The paper market is losing its grip. And when it finally breaks, when physical reality overwhelms paper manipulation, the move will be explosive. This is your warning. This is your opportunity. The silver price is being suppressed, but not for long. The fundamentals are screaming. The technical setup is building. The historical precedent is clear. And the smart money is already positioning. The only question is, will you be ready when it breaks?